Howdy there, folks. Welcome into today's video. One video and one video only for me to react to. Tom Lee went on CNBC yesterday, made his predictions for what he thinks is going to happen to the stock market in 2024. And let me just put it this way, shocking, absolutely shocking predictions he makes. I mean, woo-wee. Okay, get ready to hear some things in this video. I appreciate you joining me. Thanks so much for being here. I want to jump straight into this. Thank you for being subscribed, folks. New all-time high subscribers. I think we just hit 37K, or we're about to hit 37K, something like that. So appreciate y'all being here.
Right as to where you thought we would be, right? You 47.50 was your target for the end of this year. We're at 46, we'll call it. You said mega cap was going to lead the way. In fact, it has. Why do you think things have gone right for you and investors and bulls for the most part, especially lately?
I think people were fooled by the yield curve at the start of this year, thinking we'd have a hard landing, and they didn't want to fight a Fed, but they're forgetting the Fed was fighting an inflation war, not a business cycle. So our bet was inflation would be softer, you'd avoid a hard landing, and then we've seen the Fed kind of take its foot off the neck of monetary policy. So I think it was economists were too bearish, and the technical picture turned positive very quickly. It was a triumph of technicians.
Yeah, it's not over yet, right?
No.
And there are those who still say that the cycle's going to end because of what the Fed has already done. We just haven't seen it yet. You've heard that. How do you respond to that?
I think people should study market internal structure. We've seen a huge turnaround in cyclical stocks. The banks are turning, the regional banks are turning up, small caps are leading. This is not end of cycle market behavior. This is early cycle expansion reaccelerating.
What if it's just a late year, run as fast as you can, catch up to what you missed?
So yeah, the argument that could be made, because this is and this is something I was even talking about last year. You have two. I mean, you really only have one frame of mind, but I think you should have two frames of mind right now. One frame of mind, people are saying this is late stage cycle. We're due for a massive recession, a massive crash, those sorts of things. But open up your brain a little bit here, okay? Go with me. There's a potential we're actually early stage cycle right now. Think about it like this. 2020, what did we have? Massive, epic recession. Look at the GDP and how much it went down. That was arguably the worst recession we've ever seen in history, or certainly in a long, long time. Let's just call it that, in 2020. The unemployment rate went to the highest it had been in many, many, many decades. Like, the unemployment rate skyrocketed to the moon, right? And obviously we had a stock market crash along with that, right? Then we had 2022, which was another stock market crash. So there is a argument that could be made that maybe we're early stage into the next major bull cycle and economic cycle. And that's something that I would say less than 2% of people are factoring this reality in. Everybody is in the stage of like, we're late stage cycle, crash coming. And it's like they forget we already had two crashes in a matter of 3 years, 2 crashes in 3 years, and we already saw the unemployment rate skyrocket to double digits, right? So this is something to be considered here, and not enough people are considering it. It's, gotta think about things from a few different angles.
Money has come in and it's just chasing everything to the end of the year as rates have come down.
Well, if we thought this was a head fake, and I think if this is 98, we can run another 7% from today.
To when?
To year end.
This year end?
Well, I think 40.
Oh, you would be flipping my flapjacks. What a prediction. We could potentially run 7% into year end. There's only a few weeks left. I mean, it's December 8th today. So this was recorded obviously December 7th, but still, that's 3 weeks left in the year. What?
100 is more reasonable, but I think that if it was a head fake, we'd see credit calling baloney, and we'd see spreads widen or high yield falling. But what's happened is spreads have rallied, high yields rallied. It's actually a improving liquidity rally while investors took $240 billion out of stocks this year.
So you're a believer in the broadening of the move, and you think it carries beyond the calendar turn?
Yeah, because now as we get into next year, we'll have an FOMC decision, but I think it's going to show the Fed is no longer fighting an inflation war, but really shifting towards managing the business cycle. Huge change. I think interest rates could make a huge move lower. Mark Newton, our technician, thinks it could be 3.5%, 3.2%. And that would take mortgage rates down to 5 or under 5%, we know that would help the economy. And I think there's a lot of pent-up demand for CapEx. So I'd say that stocks could do very well next year.
Well, you must if you think we're going to get to your target for...
Yeah, could you imagine mortgage rates that go down to the fives? Or dare I say below the fives next year at some point in time? Holy smokers, that would be no joke. The real estate market. I'm considering a possibility here in the real estate market that I don't think hardly anybody's even considering at this point in time. And here's my thought process. Everybody for the last 2 years, what have you heard for the last 2.5 years? Don't buy real estate. Horrible time to buy. Everybody and their grandma is saying that. Everybody. I don't know one person in real life that hasn't said it's a bad time to buy real estate. Don't buy real estate last couple of years, right? Well, okay, so everybody's been on this buy or hold out from buying real estate and those sorts of things, right? And that's been the thought process. Well, what do we traditionally know about asset classes when everybody's saying don't buy, don't buy, don't buy? Usually it's one of the best times to buy. This is something I'm fearful about for real estate in 24 or 25, is a potential scenario where maybe maybe real estate booms in 24 and into 25, and no one's really anticipating that at all because everybody's so bearish on real estate. Look at how high the prices are of these homes. Look at the mortgage rates, all these sorts of things, right? And if we could all of a sudden get some alleviation in the mortgage rates, oh boy, okay? So I don't know, man. Like you go back to prior to the housing bubble, no one was saying don't buy homes. Everybody was buying homes, buy another home, buy another home. It was such an opposite philosophy. So if you're expecting a real estate crash right now, you're expecting a real estate crash when everybody and their grandma is saying don't buy a home. It never actually works like that. Think about that for a moment, right? What do we know about the stock market? You need to be buying when no one wants to buy, right?
2024 S&P is 5,200.
Yes.
What gets us there?
Well, it's earnings recovery. So we think earnings hit 265 by 2025. That's 2 years of like 9% growth. And you put a 20 PE. A 20 PE has happened 50% of the time when the 10 years between 4 and 5%. So it's the most common PE to apply, and that would be 5,200. But I think that's conservative because 265 is 5% of it's coming from cash, right? So there's like 3% organic growth. I mean, cash earnings is 5% growth right now per year.
I hear bears say...
That doesn't seem right.
Between 4 and 5%. So it's the most common PE to apply, and that would be 5,200. But I think that's conservative because 265
This doesn't seem right, folks. They have the Russell here at a forward PE of 20. You look at Gardini's forward PE for small cap stocks. He's got it down in the 11 to 12 range. So something's off here.
Percent of it's coming from cash, right? So there's like 3% organic growth. I mean, cash earnings is 5% growth right now per year.
I hear bears say earnings aren't going to be as good because inflation is not going to be as good for earnings. And that's going to be a negative. And that's why the market's overvalued. And people like you at $260 are just way too optimistic on where earnings are going to be.
Well, I think people should study the PPI. Like 4 or 5 sectors are correlated.
PPI, Producer Price Index.
PPI, like materials, energy. Meaning as inflation falls, they make less money, but tech and industrials have almost no correlation to inflation. And then financials are positively correlated. So I think you have more groups that could actually have better earnings power into next year. And especially if caution comes off companies. CapEx, there's a lot of pent-up demand in CapEx. 5 out of 10 groups actually sort of cut CapEx as a percentage of revenues last year. So you have a CapEx opportunity, you have a home recovery opportunity, and you have interest rates falling. It's hard to say stocks should fall next year.
So yeah, and another argument that can be, the way to think about it, right, is go industry by industry, right? Think about the restaurant industry. The restaurant industry had a horrible, really kind of like 3-year cycle because they had to go through Rona and closures, right? Then coming off of that, they finally got to start opening up their restaurants again, then got hit by a massive wave of inflation in regards to all their raw commodities that they use in the food, right? And then after that, they got hit with wage inflation in a substantial way this year, right? Coming off of the previous wave of inflation that was really around goods. Now, if you look at the restaurant industry, for instance, in 24, there's just the wage inflation, the crazy wage inflation is not there in 2024. In terms of the price of everything that they make, right? there's no major inflation going on there. And then you add on a consumer that could actually be in a much better place in 24 than 23, and that could bode well for same restaurants, store sales as well, right? So you have to go industry by industry, but net, definitely, more industries and sectors are going to be very positively affected by what's going on in 24 versus 23.
Market thinks the Fed's going to cut first in March, 3 meetings from now. Is that what you think?
I mean, to me, that intuitively seems aggressive, but
Yeah, that's not happening. That's no way.
Going to matter more is what the bond market starts to price, and I think the 2-year is telling us the Fed does have to cut meaningfully next year, because if they don't cut and inflation weakens, the level of real Fed funds is associated with a hard landing. Like the Fed, if they're trying to manage the business cycle, would be cutting rates.
Yeah, but you think it could be a little aggressive in terms of March. Do you need the Fed to be somewhat aggressive in cutting to get to your 5,200?
Yeah, the earliest I could see the Fed cutting is potentially like mid-year, and that's absolute earliest. There's a potential the Fed doesn't cut the entire year, folks. If the economy stays good and actually heats up in 24 versus 23, don't be surprised if the Fed doesn't cut the whole dang year.
The market to get comfortable with two things: that the curve can stay inverted, meaning the 10-year could actually go to 2.5 and the Fed's still at 4. And the second is that stocks and bonds don't have to be positively correlated. So yields could go up and stocks could rise. So I think that there's some protection or buffer against if the Fed doesn't cut rates.
How much do you need cash to come in from money markets that's been sitting in safety, and now it goes towards risk assets because rates have come down and you get better yield out of the equity market?
Yeah, I mean, Scott, this year if someone bought FANG, they'd be up 85%. That's 15 years of money market cash. If they buy small caps next year and small caps are at 50, that's 10 years. So I do think the $240 billion that left is coming back in. But hedge funds also have very light positioning in equities. I mean, I don't know if you saw that there's almost a 5-year low in hedge fund positioning in financials, and financials really should be where things turn next year.
You think financials are going to be one of the leaderships? What about small caps? Because that's where a lot of the conversation has been of late.
Alrighty, folks, get ready. This is when things are going to get really crazy. Get ready.
That the Russell has had.
Yes.
There's still a lot of non-believers.
Yes. I think there's the callus in place. We've had 12 years of underperformance. The price to book of small caps to the large caps is exactly where it was in 99, which was the start of a 12-year bull run. Banks are a huge weight in small caps. We know falling rates helps asset quality, so regional banks should rally. That should pull up small caps. It's clearly under-owned, and they benefit from inflows. And then, of course, I think large cap banks are really good plays on a CapEx cycle. So to me, it's easy to see the 20-30% kind of moves in those groups. I mean, small caps maybe 50, whereas it's harder to say FANG can do.
Man said 50. He just dropped a 50 out there. Oh my God.
Next year.
The other big call that you're making today, despite revealing your target at 5,200, is suggesting that mega caps, tech, not going to lead next year.
That's right.
Why?
It's that I think the earnings growth they produce doesn't look as special if the PMIs are turning up. If the ISM turns up, S&P earnings are going to grow, 15, 20%. And then in terms of multiple expansion, I think people are going to be more willing to fade a FANG multiple expansion, whereas they'll buy a financials multiple expansion.
So I want to be clear. So you think there's going to be a rotation out of mega cap into some of these quote unquote unloved areas?
Yes. I mean, FANG is still a number 3 pick, which means it outperforms. But if someone...
This is exactly how I've been talking the last several weeks. Money rotating out of a lot of the bigs into a lot of the smalls. Smalls can benefit substantially from that because when that money comes out, it's big money going into the smalls. And my opinion is the mega caps won't necessarily, I wouldn't bank that they're going to do bad next year, but there's a high probability that many of those stocks underperform the Russell and small caps significantly in 24.
Where will they get the best risk reward? I think it's clearly financials or industrials.
When you say that FANG still outperforms, the word you use, put some context to that. What does that mean?
Well, let's say S&P's up 12 to 15 next year. FANG will be maybe a little bit better. whereas financials probably can be up 30, and industrials can be up 25, and small caps can be up 50.
So we're going to really have that significant of a mean reversion trade, so to speak.
Yeah, I think it's consistent. If you look at like the history of a stock like Amazon, they have great, a step up year, and then they consolidate.
Wow. Let's expand the conversation.
So if you believe smalls are going to roll 50%, let's say you think the Russell 2000 is going to be up 50%, let's say, for instance, next year. What does that mean for a lot of underlying stocks? That means there's going to be small cap stocks next year that are up 300 to 500% in 2024. These numbers are wild, but keep in mind, some of these small caps could run 300 to 500% and still not even be anywhere close to their all-time highs. Let that sink in for a moment. That's another wild thing to think about, that they could have that sort of year where they go up several 100% and they're still not back to where they were back in 2021. That's pretty crazy to think about.
CNBC contributor Joe Terranova of Virtus and Ayako Yoshioka of Wealth Enhancement Group. It's great to have everybody with us. Aya, I go to you first. Does Tom Lee make a lot of sense or not?
Hi. Yes, absolutely. 2023 has really been defined by a very narrow market. And so it makes a lot of sense that going into 2024, that we would see a broadening out of the market, especially if the economic data comes in, relatively benign, neither too hot or too cold.
So you do think we're going to have a broadening? You agree with Tom that we're going to have these lagging sectors are going to be the leaders, that tech can still do well, it just doesn't have to carry all of the weight like it did this year?
Absolutely. I think if the economy continues to stay relatively strong, some of the, names in the lower half of the S&P 500 have a lot of room to, have the multiple expansion, as well as perhaps some upside surprises to their earnings growth as people start to anticipate a recovery from the slowdown in 2025.
Joe, is Tom too optimistic or not?
Well, first of all, Tom's been incredibly accurate so far in 2023, so congratulations for that. I run an equally weighted strategy, so I'm excited to hear your comments for 2024 because that obviously means the strategy is going to be favored. But there's 3 points I think we need to hit on. First of all, when you look at the market right now and you talk to advisors who have clients sitting in cash, the first thing that they will tell you is they expect the economy to slow. And the cash that Scott cites going into risk assets, those risk assets aren't equities. They want to put those assets into credit because they believe they're also going to get price appreciation. How would you respond to that?
I'm a fan of bonds. High yield returns 80% of stocks with less volatility. But we know that if bonds rally next year, that actually has an expansionary effect on PE. So to the extent people decide to allocate to bonds and spreads have a huge rally, it actually means there's upside to the S&P just because the multiple now has more room to expand.
So Joe, so Tom says 20 times earnings makes sense. Earnings at 260 makes sense. Is that too aggressive or not?
He's too aggressive with financials. I'm worried about financials. Let me explain why.
What about the overall? Give me the view. He says 5,200 on the S&P. Follow me. Stay with me.
No, I'm staying with you, Scott. You know me a long time. I don't do S&P price targets. I do the environment. I've never sat here and said,
okay,
we're going to 5,200.
Okay. All right.
The environment is a favorable one.
Let me rephrase it into a way that we can agree to have a conversation about that.
Tom Lee's like, please, guys, do not fight. Please don't fight. I'm here for peace.
Is the environment going to be optimistic enough
absolutely
that the S&P can get to 5,200?
I don't know the answer to that. I don't think anyone knows the answer to that. I'm sorry, Tom. I don't think anyone knows.
Can we have double-digit returns next year?
Yes, absolutely, you can.
Okay. Aya, what about you? What do you think?
I think we could have double-digit returns too, but I think the setup is very different.
I really wanted to hear him get into the banking and the financials. I'm a little upset that Scott cut him off there. I thought that could have been interesting to hear his train of thought around that.
To 2024 than what we had in 2022. We had a lot of upside surprises this year in 2023. And I think we could have some jolts depending upon how the data really pans out and how earnings really pan out in 2024.
Well, I mean, for earnings to get to $260, things have to go really right, don't they? I mean, how perfect, I hate to use that word, but in some sense, things need to be perfect. That inflation needs to come down to target. The Fed definitively needs to be done, if not cutting. The business cycle needs to keep humming. The labor market needs to remain robust so that consumers don't stop spending. Can all of those things mesh and make this a perfect, in quotes, scenario?
I mean, never say never, but at the same time, it does create difficulties for 2024. I think you're going to get bouts of it, and it's not going to be a straight path to those potential double-digit returns in 2024. I think the first half could be a little bit more murky as everybody anticipates these rate cuts, and if we don't get them and the economic data, it really does slow, and perhaps more so than everybody anticipates, then that bad news can really create some havoc in market.
Tom, how would you assess how...
Yeah, I'm very concerned about the stock market, let's call it, going down quite substantially. And when am I thinking this could happen? My thought process is at some point in the first quarter of the year, I think we could potentially have a big shakeup in the market. I don't know if it's January, if it's February, but at some point in that first quarter, I think we could have a major shakeup. And what I think could drive that is, one, I think there's a lot of people that are looking to probably take profits in the first quarter that aren't taking profits in this year because they've made so much they don't want to pay taxes in this year. They'd rather defer that out to the following year, right? So I think that's going to be a big factor out there where you're going to have definitely some big profit taken at some point in the first quarter. On top of that, you could, let's say economic data comes in really strong, you could have a scenario where, people, remember, a lot of people are starting to price in rate cuts in March, right? If the economic data comes in really, really good, it's going to be hard to keep predicting like rate cuts are coming in March or April or May, which is what a lot of people on Wall Street are expecting. And so if all of a sudden people become less confident in that and they're like, wait, maybe we're going to stay up here for a while, then that could shake up the market as well, right? So if we have a big shakeup in the stock market in the first quarter of 2024, I will not be surprised at all. I'm actually expecting it. Am I making investment decisions based upon that? Absolutely not. I'm not going to bank that the market's going to tank at some point in the first quarter and go down 5 to 10%. But I am almost expecting it. Let's put it like that.
Described what needs to happen for you to be right. Am I overstating it? Do things really need to be perfect for you to get to 5,200?
I mean, here's some simple math to think about. Earnings this year, $225. So we say 2 years, $265. So $40. 15 is going to come from just interest on the cash. So it's, 25 from organic growth, which is 10% over 2 years. It's basically GDP of 3% real. I think that's pretty doable. So unless we have a recession, 265 is actually a low number. It could be 275, 280.
Wow.
For 2025.
In earnings.
Because remember, buybacks is another 5. I mean, just buybacks and cash is 10% a year.
275, 280 will make you you're so high up, we can barely see you. We need a telescope to see your number on earnings relative to where everybody else on the street is. I haven't heard anybody suggest, gosh, you could get high as 280.
I mean, just keep in mind, this year, healthcare earnings are down 20%. They won't be down 20% for 2 more years. And basic materials and energy are down like 40, and staples are down. So we could, as those turn, those contribute to S&P earnings meaningfully, especially energy, right? Energy was such a huge swing factor. It's been absent for this year.
Why is it going to be better next year?
Well, if let's say the price stabilizes, so you just look off the curve, they won't be dragging earnings. You'll actually have a positive contribution because they're not declining. So it's not hard to get to 265, actually. Sounds strange, but that's 2 years from now.
All right. Aya, financials, energy, do you like either in 2024?
We like energy. I think the setup for energy still remains very favorable. Valuations still aren't at, extremes. I think, you've had some big announcements, in the industry that are consolidating. And, you have earnings growth. And if the economy really doesn't slow that much, if we get that mild recession or the, soft landing scenario, energy should continue to do well as we go into 2025 and beyond.
Joe, you wanted to take on Tom about his financials call. Why?
Financials and energy. First of all, with energy, what if the price doesn't go lower? It keeps, right? What if the price doesn't go higher, the price goes lower, you get a massive liquidation. Everyone is overweight energy, Tom. You know that. In addition, on financials, where's the earnings growth come from? Because if you think about it, you lose the effect of interest income. Interest income was up 22% in 2022, is up 18% in 23. It's actually going to decline next year. JP Morgan and Citi told us yesterday at the Goldman Sachs conference that trading revenue's down. You've got all CEOs complaining about regulation in Basel III. What does that leave you with? Deal making?
Yeah, well, a couple things. One, what you've described is why no one owns financials, right? Because that's why hedge funds have the lowest long positions in 5 years. Second, as George Boyd, head of Kidder Research, famously says, it takes a whole lot of E to offset PE. The financials trade next year is about price to book or price to earnings, which means it doesn't matter what earnings do next year. It's how earnings power is transforming. And look, if we have lower interest rates, we know that this saves commercial real estate, it revives housing. I don't think any investor says, oh, well, your Q2 numbers aren't going to be great. They're going to say this is a switch in how we look at earnings power for the next couple of years. So I think financials have huge multiple expansion potential. And then trading, as you know, trading is spontaneous. It's weak this quarter. It could be huge next year. I mean, $240 billion taken out, gross exposure is low. I'm not surprised there hasn't been much trading. It's going to pick up.
And remember the scenario that I think is a realistic possibility, right? You get some sort of major shakeup, massive spike in volatility in the first quarter at some point in time. People looking to take profits once again, along with all of a sudden fears about, Fed's not cutting anytime soon. And all of a sudden trading activity gets wild again, right? And all of a sudden people are short and going long, like it just all types of activity. And that's always good for all those investment banks. And they love it when the market shakes around. That's just another reason why I wouldn't be surprised if there's a big shake around in the first quarter at some point next year.
But in that scenario, you have to have a soft landing the way you're describing it.
I hope we don't have a landing. Yes.
I don't think Tom's suggesting anything other than that, and if not, no landing, right? I mean, if you think we can 270, 280 on earnings, well, we can't even come close to a soft landing. That better be a no landing, no late cycle, reacceleration of the economy for all the factors that you suggested.
Yeah, Scott. And one thing I think people have lost perspective on is when the Fed went on their tightening campaign and brought rates in the U.S. above any other developed world, we already had a hard landing in Europe and China. So the U.S. avoided a hard landing because what broke was outside the U.S. If you think those economies worsen next year, then we're in trouble. But if they're turning around and the DAX is telling you things are turning around in Europe, you don't need a landing in the U.S. because we had a...
In terms of Europe and China, do I expect those to actually strengthen in 24? And the answer is yes. I actually expect both those economies to actually get better in 24 versus what they've been in 23.
Elsewhere.
Aya, I give you the last word.
No, I think, Tom always makes some great points about, the market outlook, and betting against Tom has not been favorable, I think, to many investors. So I would go and listen to what Tom has to say.
All right.
Yeah, so recap here. I think Tom Lee's probably maybe a little too bullish, 50% for small caps. Jeez. I'm not even that bullish. I think small caps can definitely potentially outperform the other indexes next year. But man, a 50% rise, I'll take it. That happens. Thank you. But I wouldn't bank on that. I would expect more to 15 to 25% type range. But we all know Tom Lee's super. Let's call him an ultra bull. Okay. Appreciate y'all joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. I appreciate each and every one of you. If you are looking to join my Patreon, I bought 3 stocks in my Patreon portfolio here today. If you want to join me in there, that's going to be in the description area down there. You'll get have access to that Discord chat that's in there. If you're looking to apply, join my private stock group, get access to all my courses, get access to the 6 and 7 figure Discord chat, exclusive videos, things like that. Then apply, join my private group. That will be in the description area as well. Much love and have a great day.